I'm going to start off with a report off of Bloomberg actually just today that in fact the flows, ETF flows in EMs, they were outflows of $1.7 billion the most in 11 months. So are investors essentially voting with their feet when it comes to the U.S.-China trade dispute?
Well, the prospects for trade negotiations have certainly changed over the last week with the probability of a more protracted than expected trade negotiation has gone up, and that is a negative for risk assets.
So where is the biggest misprice then still in emerging markets?
Well, to the extent that this negotiation period continues for longer than expected, the dollar is likely to strengthen, and EMFX is always vulnerable. And you can already see that in the price reaction today.
And that's broad-based.
And that is broad-based. And obviously, the higher beta names are going to be more vulnerable.
So, Ben, typically you like EM.
I do like EM.
So then what do you do in this kind of situation?
Probably add to what you own in EM. I mean, EM equities actually have seen inflows so far this year. I mean, you've had massive outflows from DM. You actually had inflows into EM. EM equities haven't actually performed that well, and the dollar point is very well taken. That's been a big headwind. But I think China can look after themselves here. I think that growth differential EM DM is actually widening in EM's favor. EM earnings growth, actually, when you take tech out, is actually probably 3 times what developed markets is right now.
How much of your commitment or recommitment to EM is a function of your belief that this China trade dispute will go away in the foreseeable future? I mean, if you knew it wasn't going away, would you change your view?
I think China has the policy flexibility to stabilize growth here. I think that's what we've seen over the last sort of 6 to 9 months. To the extent there are risks in EM, I'd probably in the countries that are more exposed to that supply chain. I think they're more in places like Korea and Taiwan than they are in China per se, or the rest of EM.
Well, and perhaps Southeast Asia more broadly. I mean, one of my questions is the supply chain. If in fact this lasts for an indefinite period of time, what does that do to supply chains, and what does that do to emerging markets?
Well, it's going to impact global growth, and that's negative for emerging markets if it continues for a long period of time. Now, on the fixed income side, Korea and Taiwan are actually really strong countries, so we don't expect that to be a big impact for them. On the equity side, of course, it's a different story altogether. But I do agree that China has the ability to manage this. They have control over their monetary policy, their fiscal policy, which the U.S. president doesn't, and that does give them more leverage in being able to manage it for the economy.
But isn't part of that leverage going to be what they can do with the yuan? And if you take a look at, say, dollar yuan, the conversation is that they might not be able to devalue it in the same way that they did before with trade concerns, and that will sort of prevent them from really being able to stimulate?
Well, the fiscal policy is a different matter altogether, and they've already been doing that, and we expect that to show up in Chinese growth numbers later in the year. They can always amplify a number of things they can do there to mitigate the impact. But at this point, our base case is still that there will be a negotiated outcome. It's very normal in a negotiation process to have these kind of hiccups, especially at the last minute when both parties are trying to negotiate a better deal.
So, Ben, if you're looking at, say, Chinese equities, though, would you want to do Chinese equities that are more, say, construction-focused, consumer-focused versus, say, copper-focused or steel and manufacturing-focused?
I would say private sector rather than SOE. I mean, what's been very interesting about the Chinese policy response to date is how focused it's been on the private sector rather than the SOEs, which is where the policy focus had been before. I mean, the breadth of stimulus, the fact that it's been so private sector focused, and the fact that I think that that's how it's going to continue. So I would be focused on those private sector names, which are pretty domestic. I mean, Chinese equities per se are some of the most domestic in the world.
Shmaila, a similar question about emerging markets. I mean, is there a difference between countries that are very export dependent, very trade dependent, as opposed to countries that have much more of a developed market within their boundaries?
There is, but from an asset price perspective, investors very rarely differentiate between those countries, especially even if the closed economies are more vulnerable from a debt perspective, they tend to get impacted as much as the open economies. So, that is true over a longer period of time, but in the short-term asset price reaction, what you will see is the higher yielding countries, higher beta EMFX getting more impacted if this continues for some time.
Well, that also raises the question, too, are there any EM countries that are immune that you would be interested in buying their debt, for example, if they get taken down with this, but they're not really exposed?
Well, after the rally this year, we've been very selective in emerging markets, and to the extent that there are opportunities that emerge because of repricing of assets and overpricing of risk, we will be buyers. But certainly the lower beta countries, the Andean countries that are very, strong from an external perspective, those are the names that we would expect to be holding in much better.
There are things going on in the world besides the U.S.-China trade negotiation, believe it or not. We've had an election in South Africa.
Yes.
We have an election in India about to conclude. conclude. How do those two elections affect at all your investment thesis with those two countries?
Well, the election in South Africa actually came in pretty close to market expectation, but what we need to see here now is President Ramaphosa starting to address some of the long-standing issues in South Africa, appoint a more credible cabinet, address issues with the state-owned utility company, and address many of the investor concerns that have emerged on things like land reform and nationalization of the South African Reserve Bank.